Chapter 8, Question 1. I'm not going to go and read the whole question verbatim, but I'm just going to go through the high points of it. Boomerang, first of all, you need to make sure your calculator is set out to at least 5 decimal places. Boomerang is considering a new project. The asset investment is going to be 1.83. The project is going to last them 2 years. We see that they have some kind of depreciation using straight line, which we know that straight line is the cost less salvage value divided by the number of years they're going to have the asset, and in this case it's going to be 2 years. The project is estimated to annual sales of 1.632 with cost of $652,000. Tax rate is 35%. Required rate of return is 9%, and they're asking us what the net present value or the NVP for this project is. Now the first thing we're going to do is we're going to calculate the OCF. OCF is the operating cash flows, and according to the text, page 248, 249, and 250, there's 3 approaches to calculating the OCF, and we're going to go with the tax shield approach. Now, because we know that there's going to be an asset that's going to be depreciated, and we know that depreciation is a non-cash item, which basically means for every dollar that we lose in depreciation, we're going to gain 35 cents in taxes. And so if we go with the formula for OCF, it's basically sales less the cost times the tax, 1 minus the tax rate, and then we add back what we're going to save in taxes. So once you do the math, and for this particular problem, you come up with an OCF of $957,780, which basically says that this is how much money we're going to have at the end of the project. And so the NPV of this project is we take what we initially invested in the project and we take out what we're going to have at the end, the profit we're going to have at the end of 2 years. And in this case, we have to take the $957,000, which is in the future, and try to bring it back to a current value so that we can, basically we can compare apples to apples and not apples to oranges. Because if we were just to take the 1.836 minus the 957,000, it'll be comparing 2 numbers that are not the same. So we use the present value initial factor to bring back that amount in the future back to the present. And if you use the table that I believe is on the put under explanation, the use table 4A under the website. And so once you take the table and look up the present value initial factor for 9% in 2 years, it comes up to, I think, like 1.7 something, and multiply that into the 957 to bring that 957 back to a present value. And then you take the 957 out of the $1.836 million, and we come up with a negative 151,000. Now, if the question was to ask us if you want to accept or reject the project, we'll reject the project just basically because we're losing money out of it. But since it's not asking us that, we're just going to go ahead and give it the net present value as $157,158.49. Thank you, and on to the next question.